So we've all heard it, right? That most retail traders lose money. But the usual explanations, they're just too emotional or they lack discipline, that stuff doesn't really get to the heart of it. In this explainer, we're going to cut through all that noise and get to the real, data-driven reasons why so many accounts end up in the red.
Okay, let's just start with the cold, hard numbers. Broker disclosures, the ones they're required to publish, show a pretty staggering statistic. Somewhere between 70 and 80% of retail accounts lose money. This isn't just a myth or an exaggeration, it's a statistical reality reported by the industry itself.
So, that's the what. A huge number of people are losing. But the real question, the one we're going to unpack here, is why. Why is that failure rate so consistently, brutally high?
Well, the easy answer you always hear is that people get greedy or they get scared. And sure, that's definitely part of the picture. But the data points to something much deeper. The problem, it turns out, is far more structural than it is motivational. It's actually baked right into the way most people are taught to approach the markets.
So here's our game plan for today. First, we're going to tackle the losing formula. Then we'll let the data reveal the real culprits. After that, we'll dive into the psychology of self-sabotage, what actually improves your odds, and finally, how to adopt a true winner's mindset. All right, let's jump right into section 1, the losing formula. Before we can find any kind of solution, we have to really understand the problem, and that means moving past those simple and frankly pretty unhelpful old myths. A data analysis I saw on Reddit really nails it with this quote. The issue is far more structural than motivational. Think about it. Telling a trader to just be more disciplined is like telling a pilot to fly better without checking if the plane's engine is even working. We have to look under the hood at the trading approach itself. And that leads us perfectly into our next section, Data Reveals the Culprits. We're going to look at 3 major structural leaks that are constantly, quietly sinking trader accounts, day after day.
Culprit number 1, and this is a big one, is overtrading. A really famous study by 2 professors, Barbara and Odine, looked at thousands and thousands of brokerage accounts, and what they found was a direct negative link. The more people traded, the worse their returns were. It's just simple math, really. Every single trade has costs, commissions, spreads, slippage, and they all just eat away at any edge you might have.
And you can see the impact of all that extra activity right here. While a simple market index did its thing, the most active traders lagged way behind. That gap, that's a 6 to 7% underperformance every single year. So clearly, being busy and clicking more buttons did not equal more profit. In fact, it was just the opposite.
Okay, culprit number 2 might actually surprise you. It's not about being wrong about which way a stock is going. The data from brokers shows that the number 1 driver of losses is actually terrible position sizing. People just bet way too much on a single idea, and that one bad trade can do catastrophic, unrecoverable damage to an account.
This data is just fascinating. It shows that a lot of traders actually win more often than they lose. So what's the problem? Well, for every £1 they make on a winning trade, they lose, on average, £1.66 on their losers. That toxic ratio means that even if you're right most of the time, your account is just slowly, painfully bleeding out. Now, to put all this in perspective, just think about what the pros are doing. They're not just guessing. They're managing risk with a whole complex framework of math variables called the Greeks: delta, gamma, theta, all these things that measure how sensitive their portfolio is to every little shift in the market. For them, it is a risk management business, not a prediction game. So you've got these structural problems. And then our own brains come along and just pour gasoline on the fire. Which brings us to section 3, the psychology of self-sabotage, how we become our own worst enemies. Researchers at MIT actually identified what they called a trio of wealth-depleting mistakes. They found that retail traders consistently do 3 things. First, they pile into whatever stock is hot in the news, paying way too much for options. Second, they get eaten alive by huge bid-ask spreads. And third, they hang on way too long after the hype has died down, just watching the value of their trade evaporate into thin air. And this all leads to a behavior that's so common and so destructive, it even has its own name: revenge trading. It's that feeling, that gut reaction right after a loss where you just have to jump back in and get your money back. And when that happens, forget the plan, forget risk management, emotion is now flying the plane. And that almost always leads to an even bigger crash. It really just boils down to 2 totally different ways of thinking. On one side, you've got the lottery ticket mentality. Every trade is the one. It's a make or break gamble.
But on the other side, you have the strategic mindset. A trade isn't a gamble, it's just one statistical event in a very long series. It's part of a process.
Okay, enough of the doom and gloom. Let's talk about how to fix this. Section 4 is all about what actually improves your odds, the data-driven prescription for getting better results.
So when you look at all the research, it points to 5 key structural fixes. 1. Trade less, not more. Focus only on the best setups. 2. Cap your risk. Never lose more than a tiny fraction of your account on one trade, like 1% or even less. 3. Size your positions smartly based on volatility. 4. Review your performance like a scientist, not just looking at profit and loss. And 5. Match your strategy to what the market is actually doing. Notice something? None of this is about predicting the future. And here's what that risk cap looks like. This is the job of a disciplined trader. Job number 1 is preserving capital. So on any given trade, 99% of their money is safe. Only 1% is actually on the line. This is what guarantees you'll survive the inevitable bad luck and be there to trade another day. And finally, all of these structural fixes, all these rules, they're all powered by one crucial shift in how you think. And that brings us to our last section, adopting the winner's mindset. This is about going from a gambler to a business owner. This really gets to the heart of it. Where is your focus? Most traders are obsessed with the outcome. Their mood goes up and down with their account balance. But successful traders, they are obsessed with the process. They get their satisfaction from executing their plan perfectly, whether that one trade wins or loses, because they trust their system's edge over the long haul. And this leads to a pretty wild paradox, which is captured perfectly in this quote. The more you try to control what happens on this one single trade, the less control you actually have over your long-term success. You have to let go of this single outcome to gain control of the big picture. So if you only remember one single thing from this entire explainer, please let it be this. Successful trading is not about having a crystal ball. It is the boring, repetitive, disciplined execution of a system that has a statistical edge over and over and over again. It's a business, not a trip to the casino. And that leaves us with one final crucial question for you. When you really look at what you're doing, honestly, are you building a system, a real business with a quantifiable edge, or are you just buying lottery tickets and hoping to get lucky?